Today is Tuesday, 17th September. First, we're going to talk about critical price points as usual. Finally, we trade up into the weekly volume imbalance with the settlement prices toggled on. Right now it's toggled off. Then we have important price points. Right now, the consequent encouragement of previous wick and the consequent encouragement of the week of 28th of August. These weren't very specific at the highs and lows, but they were specific if I wanted to confirm my trade to when the price already went down. For instance, when we came in here, we went down and then went up. Then this point was a resistance point that I could use to trade further down. But more importantly, if we take a look at the inverse fair value gap of 12th of August, this one, we divide that up in quadrants. We can see once again the 25% range of the inverse fair value gap is being used today again to frame a point of resistance. Today, very important was the closing on the weekly chart, was the closing price of previous week of 9 September. So let's zoom into the daily chart to see why that is important. We can see once again the previous weekly closing price and the 25% range of that. We immediately observe a inverse fair value gap, a daily fair value gap, excuse me. Yesterday we traded into that, we left the portion open. Why was this point so important? Is because we have this order block. When we were up here, this was still an order block. Then we annotate that as because it was in close correlation to that weekly point. And this is the most important point because my best trade was framed on this. And so was the short trade that was framed on the weekly volume imbalance. The 25% range that I previously annotated, we divide this fair value gap up in quadrants. We have the midpoint of that, which is the daily low of today. We zoom into that and we see the 4-hour chart. We immediately observe a 4-hour fair value gap. As you can see, we trade again this weekly chart and then we trade to this 4-hour fair value gap. Why is this important? Because yes, it's the consequent encouragement of the daily fair value gap that we just annotated. So let's go again to the most important price point of the day, the previous day order block. When we have the settlement price, this was previous day settlement price, we draw that up into quadrants and we see the midpoint of that. We just do that visually now in our imagination. But this one right here, today's, we divide that up in quadrants and the half point of that, close to the half point at least, is the previous day order block. This is on the 15-minute chart. Around here was midnight open. We trade up to the weekly and volume imbalance. We trade down to the consequent encouragement of the daily fair value gap high. So let's have a naked chart. All this didn't existed with the AM and PM session. So this, with my cursor here, from this point to this point, this moment forward, imagine that this is not there. And we start trading here. We can see equal lows here, equal lows here. So my eye immediately went to this. Obviously, the most important price point in here, we take a trade, and then we take a trade in here to take out these relative equal lows in here once again. We don't need to trade below that, but price in here showed me willingness to go down. So then we immediately have the entry models. This is the previous day order block. As you can see, we trade up to the weekly volume imbalance. And once we come inside of that, yes, we trade down all the way to take out the relative equal lows. The 15-minute chart over here, the 1-minute chart over here, the two trades that I annotated. We're gonna talk about that now. As you can see, 9:30 opens. The first thing we see is we see buy side. We take out buy side. Then we have relative equal lows. We want to take those relative equal lows out to then trade higher to this weekly volume imbalance and those relative equal highs that have been left open since previous week or weeks before. That's my I want to trade up to that some point, you know. But today we traded up to the weekly volume imbalance, the halfway point of that. We traded down. After this, what can we see? This is major buy side. This is major sell side. This is minor buy side. We take out the minor buy side. This now becomes minor buy side. Still major sell side. We take out this low. We trade up. We don't take out this high. We trade lower. Take out this low again. We trade up higher. We don't take out this high. We leave relative equal highs. We trade down. We take out this low. We leave the major sell side intact, and then we trade up to the major buy side liquidity. So now, that should have stated major now. So when we do that and trade up into the high point of resistance, it's reasonable to trade lower then to maybe take out this for lunch, or maybe take out this for lunch, or maybe even now before 11. We do that, we can see we traded down in here, we come up again in the optimal trade entry, then trade lower, and then trade down again. So the first trade that I took is concerning this part, and this is the trade that I'm going to talk about today. So we annotate 930, the opening price, the opening range gap, the low is way lower than this. Remember that this was the midpoint. We have the 950 till 1010 macro, and then in here it's before 10 a.m. It still looks clean. We color outside the box because it's the day before FOMC, so we can expect some wiki price action in here. Same as here, we trade lower out of this inverse fair value gap in the volume imbalance. That's just the day before FOMC. I would have loved to see that we respect this low in here when it's a normal day. We respect the midpoint of the inverse fair value gap, and then maybe take out this low, but not to this extent, and then trade up into here. So this is the first presented fair value gap. We see the sell side is left open, the previous day order block. We want to trade into that as first target, and possibly maybe even have a range day to trade the sell side that I originally mentioned in the previous slide with the naked chart, and I said imagine that this doesn't exist, and we want to trade up to there. First, initially we trade up higher to take out all the short sellers. We trade up higher, and then eventually we trade up lower. In here we cut out the the gamblers. This is the trades that we want to focus on. In here we trade down to the sell side to take out buy side. We just trust the first presented fair value gap. Your stop comes above here. We trade down, we take the profits, and then up here we see we have a willingness to trade up. We still have an inverse fair value gap, but I trust that this becomes an inverse fair value gap and we don't trade into that and then trade lower. But we can wait for initially up here, and when price trades below this we trade up higher. But I really trusted this one because we come from a high point of resistance. So what we do is we annotate the order block, the consequent encouragement of that, which also happened to be very closely to the opening price of the order block. As you can see, we leave inefficiencies. We don't trade to the midpoint yet. We come here. I buy this. Okay, it's risky, but I trust that we are going to get higher, and then if I lose, I lose. So I buy this. We trade up higher. I trilled my stop loss to here, and I got stopped out because I forgot it was the FOMC the day before that. Don't have a lot of experience with it, to be honest. And then we trade into the volume imbalance that was left in here. We trade up into that, and then that's the trade, the two trades, the short one and then the long. And then we're gonna trade a third time today to take a short position, which is related to this price action in here. So let's zoom into that. Also, I forgot to mention that this is, when we zoom to the left part of the chart, this was in a 50-minute fair value gap. We don't fill that fair value gap all the way, so it's very bullish momentum. In here, we see 1050 to 1011 macro. We have this inverse fair value gap. We trade below that. Then we trade higher again. We trade above the midpoint inside this fair value gap. This is definitely where I would short. So we put a short trade in this, as you can see in here. We finally leave the inverse fair value gap in here. We leave that with an inefficiency. So this candle, the opening price, when we trade back into that, or the low of the price, when we trade back into that, that's when we hit the short button, and we sell short to take out this as first target, and this as second target with a major sell side liquidity. Eventually we trade up, and we see this back and forth, very colored, good colored in price action, which means that no matter what happens, we're gonna go up. We went up to the optimal trade entry. I took the wicks today because it's the FOMC. Normally I would take this body and then this body, and then we trade into here. We check, do we have a willingness to trade lower? Yes, we do. And we observe a volume imbalance. We trade back into the volume imbalance, and then of course we trade lower with this. We see a high, a low is being taken, sell side is engaged now. Then we still want to trade maybe into this, and we read this price action now. We annotate this fair value gap. I do this in my head. This fair value gap in here, we extend it out in time. We see we don't want to trade essentially up above that, and what we can see inside of that fair value gap is that we keep engaging the buy side, and here sell side is being left open to then trade up down to that. We see momentum in here, the consequent encouragement of that order block. Still not convinced. I would have loved to see that this fair value gap would form higher before it would take out this low, but this low is still open, and this low is also still open. So in here finally we leave a fair value gap. When price trades back into this candle's low, the closing price of it, when it trades back into that, in this case we trade into the fair value gap, even trade wick above that because of the fair value gap, because of the because of the FOMC meetings that's going to happen tomorrow. We definitely take this trade and then trade lower to take out the ultimate sell side eventually. So thank you very much for watching. If you are a very experienced trader, please leave a comment about what I missed or what I did wrong. If you are I consider myself an amateur. If you are a beginner trader, then always ask me questions, and I can help you to level up to the amateur level of trading. Thank you very much.